Good morning, everyone. It's my pleasure. My name is Roxana Mihet. I'm an assistant professor at the University of Lausanne, and it's my pleasure to introduce Hélène Rey for this Laffont lecture 2024. So Hélène Rey is the Lord Bagri Professor of Economics at the London Business School, and until 2007, she was at Princeton University as Professor of Economics and International Affairs in the Economics Department and the Woodrow Wilson School. She was elected president of the European Economic Association in 2022. Hélène Rey's research, very well published in the ER, QGE, Ristad, and many other top journals, focuses on international macroeconomics and finance, with a special emphasis on financial stability, international capital flows, exchange rates, and the international monetary system. Today, we have the pleasure to listen to her presentation on elephants in equity markets. So welcome, Hélène. Welcome to Rotterdam. We are very excited to hear your talk.
So many thanks, Roxana, and many thanks for the invitation to present this Laffont lecture. Of course, it's a great pleasure to present it here in Rotterdam, and also it's a great pleasure to present the Laffont lecture. I met Jean-Jacques a long time ago, at the very beginning of my career, and was a very impressive human being, really pushing the boundaries, both in terms of research and also institutional boundaries, trying to improve the common good as much as possible, of course. And I remember vividly my first encounter with Jean-Jacques, because we were both visiting Berkeley at the time. I was a very young assistant professor, and we met a bit by chance on the campus, and we spent a good amount of time talking about economics, but also I remember our complaints about France and the French at the time. So it's a great pleasure to give a Laffont lecture today, and I will give it on this kind of new line of research, of which here you have the new paper, which is called Elephants in Equity Markets, and which is joint work with Adrien Rousset-Plana and Vanya Stavrakeva at the London Business School, and also Jenny Tang at the Boston Fed, with the usual disclaimer which applies. It sounds like we are stuck on the first page, which is not a bad thing, but it's not moving. Yes, thank you so much. Thanks a lot. So this fits in my research agenda, which has been for a long time about independence of countries, international spillovers of large central banks' monetary policies, in particular the US Federal Reserve and the role of the dollar internationally, and also more broadly the structure of the international monetary and financial system. So I have always felt that it was very important to look at interdependencies in the world economy via different prisms. So the prisms of international trade linkages, so international trade network is one, but also the prism of international financial networks. And by differentiating between these different networks and trying to understand how shocks transmit in those networks, one could learn quite a bit about interdependencies of countries, and in particular, the effect of monetary policy on various economies. So obviously, this line of research might be, in my view, even more relevant today, given that we are going through potentially large reshaping of geopolitics and of currency and trade blocks in the world economy, and therefore understanding better the role of networks and how shocks might propagate within blocks or across blocks is, in my view, a very important issue in the research agenda. So this lecture will fit totally in this type of line of thought, but I'm going to be focusing very squarely on the international finance network here, and on a specific type of international finance network. I'm going to talk a lot about global equity markets and exchange rate. So that's going to be really, it's an important international finance network. I hope you will agree with me at the end of the talk. It's going to be a very simple, in a way, framework. I'm not going to do any fancy econometrics or anything like that here. I'm going to mainly be using some market clearing identities and some data, which is going to be a very international data set. But I hope you will agree with me at the end that by looking at that, we will learn quite a bit about the international finance network. So why am I looking at international equity networks and international equity investment? Well, if we think about the investment of global funds, so international equity funds, and here I'm going to be using data from mutual funds, these are extremely diversified investors internationally, so they invest in many different markets, and whenever they invest in a certain market, so for example, here I'm taking, let's think about a US funds investing in a Brazilian stock market. Well, this gives rise to two types of transactions. There are two types of assets which are being involved in this type of investment. You have obviously buying a stock in Brazil, but also you have a corresponding forex market. Okay, so we have a very intimate link between buying a stock and a transaction on the foreign exchange market. Now, of course, the world is not only bilateral. That's the point, even though we have a lot of bilateral models, because that's very much easier. The world has a lot of interconnected countries. And not only we have US funds, but you have also Euro funds, which may also be invested in Brazil. And therefore, we are going to have also the Euro Brazilian real exchange rate, which will be involved in the market clearing condition here for Brazilian stocks. And so on for any other country. The Japanese investors investing in Brazil will have the yen coming in, et cetera, et cetera. So we have a whole bunch of investors with different home currencies, which are going to be invested in different stock markets around the world, right? So that connects intimately international equity markets in various countries, with a whole bunch of bilateral exchange rates between the investors and the currency of the stocks that they buy. Okay, so we have this entire kind of matrix of investors with bilateral exchange rate and equity purchases. Okay, so what am I going to be getting out of using this very simple framework that I will explain to you? We are going to build on a novel decomposition of equity price growth rates, very simply, in terms of equilibrium demand, so equilibrium holdings of equity, which is going to be based straightforwardly on an ex-post market clearing condition. So I'm just going to be using an ex-post market clearing condition for each stock, essentially, around the world, for which I have data. And what I will show you is that with a data set, so it's going to be the Morningstar mutual fund data set of asset managers, which has a coverage which is limited. It has, on average, 5% coverage of the market. Well, we can actually reconstruct equilibrium holdings, which account for roughly, so in a variance-covariance sense, in a statistical sense, which accounts for about 90% of the monthly variation in equity growth rate for all the stocks we have, which is above 20,000 individual stocks. And by aggregating up, I will also be able to essentially account, again in a statistical sense, for the fluctuations of 33 aggregate stock markets. So I'm stressing from the beginning that I'm not going to be here trying to identify shocks and looking at causality. Okay, but I'm going to be using simply market clearing condition, but I guess the message of this framework, which is a framework in which you can nest, therefore, any model that you're going to write in asset pricing, since any model we are going to write has asset clearing conditions and market clearing conditions. So that simple empirical framework has a remarkable empirical fit despite the odds in some sense. 5% coverage, that's not much. And yet, you're going to see the empirical fit that we're going to be able to get is pretty large. Hence, this idea that for some reasons, the asset managers are like elephants in equity markets, and by looking at them, and maybe because they are behaving like elephants' herds actually, we can learn quite a lot on about the international finance network. All right, so how is it going to work exactly? So from now on, I'm going to show you the very simple decomposition that we do. And I'm going to be implementing it in the data, both at the micro level and also aggregating up then at the macroeconomic level. Okay, so that's going to be my job here during the time we have together, and I will obviously show you the result. So if you look at the market clearing condition, I'm going to show you the equation in a minute. Well, for each stock, take an Apple stock, you're going to be able to express the market clearing condition for the Apple stock with the supply of the Apple stock in nominal term on one side, and on the other side, you're going to have the nominal holdings of the Apple stocks, which contain effectively, in an international equity network, it contains 4 components. You will be able to see that it contains, as I said before, the exchange rates, which are going to be very important here. It contains net portfolio returns of investors. It will contain the portfolio weights of the funds, and it will contain also the final fund flows of investors, that's the final investor putting their money or withdrawing their money from mutual funds. And using this very simple decomposition, we will look at the various subcomponents of this demand and various stylized facts on how this correlates and co-moves with price at the micro level and the macro level. So here it is. First, I will show you the stock market growth rate decomposition, price growth rate decomposition. Then I will show you what we can get out of that, and I will move on to extract some interesting information about exchange rates. So the stock market price decomposition. That's the market clearing conditions, could not be simpler, but I'm going to be working with. So I'll just pause a little bit here on this slide because you need to kind of get used to the notations. On the right-hand side, we have a nominal supply of a given stock. So a stock is indexed by J. For me, a stock is like a Nicene. Okay, stocks are described by Icene, so Nicene and stock, I use them interchangeably. So the nominal supply is just the price of that stock J multiplied by the quantity at date T. And on the left-hand side, you have the nominal demand. So nominal demand equals nominal supply. So what's the nominal demand? So it has these 3 terms here. The omegas are just the portfolio share invested by an investor I in the stock J. So it's an omega ij. Okay? Then we have the asset under management of investor I in units of its currency. Okay? So that's going to be WI. There's a region of sale for a fund, and that's going to be the currency of a region of sale that I'm going to be using here. And then we have the exchange rate, which converts the currency of investor into essentially the currency of the asset he or she is buying. So the exchange rate are S here, right? So nominal demand equals nominal supply. And if you remember, so now the wealth, the asset under management is W, and the omegas are essentially the weights. S are the exchange rate, PQ are price and quantities. The wealth or the growth rate of asset under management is a function of the net of fee portfolio returns and final funds inflows and outflows. So it's just an accounting identity about the time variation in the asset under management. So again, I'm not doing anything complicated. I'm just using after a market clearing condition, I'm using an accounting identity here. The flows, they may come from retail investor, and they may go in and out of the funds. I'm going to be linearizing this market clearing condition together with this dynamic equation of the assets under management around sample averages. And I won't say anything here about the quality of the approximation ex ante, and we will actually look at it ex post and see how well we actually are doing with this linearization. So if I look at this equation, now the only thing I've done here is that on the left-hand side, you have the growth rate of the price of a stock. Okay, that's the delta PJ. Think of it of the price of the Apple stock, for example, or the price of the LVMH stock or whatever. And then I've put the delta Q on the right-hand side, so that's the change in quantity of a stock, right? So that was delta P plus delta Q. And then I have these 4 terms coming from my market clearing conditions. The first one is going to be the exchange rate change in the bracket. The second one is the change in weights of an investor I or stock J. And the RI is the return net of fee, and then the flow is the final investor's flow. Okay? And then I have this weight in front, which is the sample average holding of stock J by fund I relative to the sample average market cap of a stock. So everything is, for the moment, I haven't made huge amount of assumptions. I just do a linearization. Now, of course, if we want to look at this market clearing condition, linearized empirically, my summation here, sum of over all the I, is over all the investors investing in the Apple stock, or in the LVMH stock, or in the Toyota stock, or whatever stock, or Tesla, etc. Okay? So I would need to reconstruct that object here. I would need the whole universe of investors in a given stock. And I don't have that. Thing is, nobody has that. So I have only the coverage that is in my data set, which here is the Morningstar Direct mutual funds data, and which is relatively low, average 5%. So we are going to be making some assumption here about something like the representativeness of a sample of that is in the Morningstar data. And I'm going to explain exactly what we mean by representativeness. So you see here that I am in the process of trying to just empirically implement a market clearing condition at a very granular level. So this is a bit of a strange thing to do, or maybe an interesting thing to do, because we write this market clearing condition all the time in economics. But actually, we have, or I don't think we have ever really looked in the data as whether we can reconstruct, so at a very granular level and then at the aggregate level, this market clearing condition with the data that we have. So here I'm going to do that with stock market data. And we can discuss maybe towards the end whether we think that we could do that with any other type of market clearing condition. And this is actually an interesting question, because this market clearing condition that I'm going to be reconstructing has exchange rates in it, plenty of exchange rates in it. But all the international economic models have also, whether they are on the goods market, to equilibrate balance of payments, or goods flows, or service flows, etc., they also have exchange rate in it. So there are plenty of market clearing conditions in international economics that have exchange rate. The exchange rate is a variable that equilibrates markets of goods, of services, any financial assets, of bonds market, equity markets, derivatives markets, etc., etc. So it's an ubiquitous variable. It appears in my market clearing condition, and I'm going to be looking at this particular market clearing condition and see how how well we can do with the data to actually reconstruct this market clearing condition. Okay, so how am I going to be doing that for the international equity market? First step is that I'm going to be, of my aggregation methodology here, is that I'm going to be decomposing the weight changes, the weight rebalancing, for a given stock, a given ISIN, by a certain fund I, into a very simple, we can call that a one common component. I mean, it's just an unweighted average within types of funds buckets. So I'm going to have different types of funds. I can observe in the Morningstar data different types of funds. Some are active, some have broad strategy, some have strategies which are about relatively value growth or whatever. Some have rebalance frequently, some infrequently. I have all kinds of information. I also know, of course, the currency of their region of sale. I'm going to construct fund buckets, and within each bucket, I'm going to be decomposing that weight change into a common component and a idiosyncratic component. So very simple decomposition, but I do it by hand. Okay, I'm not even using any econometrics. So that's for the weight rebalancing component. What does it look like? So here we go, finally some nice colors, finally a little bit of art. This is for Apple. This is for the Apple stock here. So for the Apple stock, we have this weight rebalancing component. For each point corresponds to a different fund, right? So we have, this is monthly data since 2008, as you can see, until 2022. And each point corresponds to a different fund. In red, you have the index funds, and in blue, you have the non-index funds, so the more active fund. And what we can see here is a lot of heterogeneity. Okay? These points are pretty much, all over the place. And the little line that looks a bit like noise, but it's a little line in the middle, is simply the average. So the common component, the average, that I defined before. So you can see there's a yellow and a green line. They correspond to the average for the active, that's the green one, and for the yellow one, that's the passive. You can see that they are pretty much on top of each other, and they capture some variation, but really a lot of the heterogeneity has been squashed, okay, by this averaging. And this is quite representative. I mean, I show you Apple, but this is essentially quite representative of what we see across many stocks. Now, I do the same type of aggregation methodology for the flow component. This time, it's not dependent on IJ, it's only dependent on I. The flow component is dependent on the fund, okay? And again, I do a simple average by investor group, and I will have a common component and an idiosyncratic component. And same thing for the return of a fund, net of fee. Okay, so that's going to be also a fund level variable. And I do the same common component and then some idiosyncratic component. And again, there I do observe a lot of heterogeneity, and then I construct these averages. Now, once I have that, I'm not done. In order to kind of scale up my small sample to the market-wide kind of representation. So the second thing I'm going to be assuming is that these sample average weight changes, flows, and net of fee returns by types of investors, by fund buckets that we observe, essentially they capture well population averages. So I'm going to say, what I observe as an average, that's a good representation of a population average. And then I'm going to say also, I have somehow representative holding ratios. Across type of funds, essentially the ratio of holdings of a certain stock relative to population holdings is going to be the same across types of funds. So I have representative holdings ratio. So I'm going to make this assumption, and if I have all these assumptions together, then I can scale up the data that I have to the market. So this is what I'm doing. And if this is the case, then after scaling up the average of what I observed in the Morningstar data, then I can reconstruct the kind of market clearing condition that I started with from my Morningstar data. So this market clearing condition is telling me, again, the variation in the stock price, delta Pj here, is dependent on these 4 components, which I have, the exchange rate change, exchange rates all over the place, right? They come from any kind of countries which is investing in the Apple stock. So you have the Colombian, the Japanese, et cetera, exchange rate entering in there. Plus, you're going to have the fund flows, which are coming from the final investors. You're going to have the change in weights, and then you're going to have the return on the portfolio. So all my 4 components are there. I've now reconstructed them. And I've reconstructed them using these averages. So I also keep, I don't throw anything out, I also keep the residual variations that I had, all the idiosyncratic stuff. I've constructed that. So I'm observing everything. I've constructed everything. I have everything here. I'm not, throwing anything out. And then I have the change in quantities also, which entered the supply of the stock. So that's it in a way. So now, for the micro level, that's what we needed to construct this market clearing condition for each stock. So now let's take our data. So our data is the Morningstar Mutual Fund data. It has about 36,000 funds. It's at the EISIN level. And we supplement it with some other data on stock prices. We have about, in the monthly time series, $25 trillion of asset under management. If we go to the quarterly series, we have 50 trillion, 33 stock markets, 33 currencies. So it's a very international data set, and it goes from 2008 till 2022. Now we have very high correlation between our weighted stock market growth rates and the actual stock market indices for the respective country. So it's about 96%. Right, so how well are we doing? Here we go, I'm starting with just showing one stock for a moment, which is Toyota. So Toyota, what I have here, if you look at the red line, is the stock price growth rate of Toyota. Okay? So it's the actual stock price growth rate. And the blue line is what I can reconstruct from my Morningstar data in terms of my total components of demand, so the left-hand side, the 4 components that I've been reconstructing, again, from all over the world, investors, so exchange rates coming from all over the place. All these components are here. And we look at how well we are doing, and you can see that the fit is really good. Right? It's pretty good. And then we look at what is the coverage for Toyota, 5%. So somehow our elephants are doing a good job. Even a very good job. How many funds holding the ISINs per month we have? Well, about 450 on average. So, we have, it's a big number, but it's not a huge number. But that seems to be enough information in order to get this decomposition working. Now, in the specific case of Toyota, we can look at what is the role of each of these specific subcomponents that we have been building. So in picture, here's what it gives. If I put only the portfolio weight changes, So this is the blue line, and still my stock price is in red. You see that the portfolio weight changes for Toyota. They explain quite in a statistical sense, again, not in a causal sense. Okay, I insist on that. Quite a bit of a variation in the price of a Toyota stock. You see the gray areas, they are the kind of difference between the actual price and what I can reconstruct with change in weight here. So you see there is some gray areas. I'm not picking up all the variation if I use only the portfolio weight. So now if I add the exchange rate component, coming from all these exchange rates, I get a little bit better. The gray areas are going down. Now if I add the flow component, so the final investors' flows into funds, I get better still. And then if I add the total net return component, then I do pretty well. Okay, so each of the components adds something to the picture and get you pretty much close to being able to reconstruct this market clearing condition, worldwide market clearing condition for the Toyota stock. Now, is it specific to Toyota? No. So here is Apple, my Apple stock. So remember, I had these dots, the weight changes, they were all over the place, right? The weight changes. There was a huge amount of heterogeneity in the weight changes. And then I was taking these averages and I was completely flattening them. And I was getting this little variation in the middle of my graph. Well, this little variation, they give you a pretty good fit. Because that's what we get for Apple. So here the coverage is a bit higher. It's 12.5% for the Apple stock. Okay, so with 12.5%, we can pretty much reconstruct the market clearing condition with a low degree of accuracy. Here we have the average number of funds holding the stock is about 1,216. So more. Now this is LVMH. If we look at LVMH again, you see that the fit is fairly good as well. Now you may be starting to worry, is there anything mechanical here that we haven't seen and that explains the fit, and is it always working somehow because, I don't know, there's a price on the left and a price on the right? But actually, that's not the case. There's nothing mechanical in this. Because we can do our decomposition conditioning only on funds which are actively changing portfolio weights, so not holdings. Your portfolio holdings move up with a price. Okay? So when you have purely passive investors, they are going to be acting as amplifier in our decomposition. But we can do the decomposition with people we observe change in weights, so we can actually do the composition only with a marginal change in weights funds, and this works exactly in the same way. And the passive holdings just amplify whatever the active change in weights actually do. So there is no mechanical price-on-price type of things. And plus, again, the other components of the decomposition contain, the Colombian yen exchange rate and the dollar, peso, et cetera, So these are not exactly things that are known to move with any co-movements of things that we know about. Okay, so there's nothing mechanical. So therefore, there's something maybe, there has to be something deeper that is going on. So we are going to be exploring this a little bit more systematically. I've been showing you example of stocks. So now I'm going to be doing a systematic variance-covariance decomposition for all my 20,000 stocks at the microeconomic level still. So I'm just going to be using my decomposition, and I'm going to be regressing each of my subcomponents, the exchange rate subcomponents, the fund flows, the return, the change in weight subcomponents, on the change in price. So to recover this beta, this is a variance-covariance decomposition. It doesn't sum up to 1 here, but it gives us an idea of what is explaining most of the variation within the subcomponents. So when we do that, we see the distribution for all our stocks here. So you see this on the left-hand side. See that we have quite a bit of the variance-covariance decomposition, which is close to 1, which is good news. And we also have some tails. So we have some stocks for which it doesn't work very well, this decomposition. We are not doing a very good job. But for most of the stocks, we are doing a pretty good job. Okay, we are in an area close to 1 for a large number of stocks. Now, you might also wonder, so we have been explaining the price, what's happening to the quantity of stock, so on the supply side? Are there lots of changes in the quantity of stock? And actually, if we look at the change in quantity, this is the panel on the right, it could be either positive if there are new issuance, or negative if there are buybacks. You see, we have a big spike at 0. So essentially, the quantities are not changing that much. And there's a few buybacks or a few new issuance, but it's not a huge amount of variation explained by that. Okay? So for most of the time, I'm just talking about the demand, the change in the demand explaining the price, and I consider the variation in quantities not being very important here. All right, so now what about our 4 components of demand? How much of the variations in the change in price do each of them explain, again, in a variance-covariance sense? Well, if we look at this common weight rebalancing component, the little line that I got by squashing all my heterogeneity, you see that for most stock, actually, at the micro level, this is what explains quite a bit of the variance, okay, of a change in price. Exchange rate valuations, we have a big spike at 0, and then we have something on the tail. So why is the spike at 0? This is a reflection of something that we know and that I've been working a lot on over the years, which is that a lot of assets are simply dollar assets. And a lot of wealth is dollar wealth. So for a lot of the sample, for part of the sample, we have dollar investor into dollars. Okay? So the exchange rate there doesn't play a role. And then we have a share explained by final flows, okay, which is positive on average and there's some heterogeneity there. Similarly, for the share explained by the common component of a net of fee return, which is the last one on the right. All right, so when does that not work? So it's not mechanical, but it also does not always work, okay? Then, so let me show you some case where it doesn't work. So if we take some stocks, like here we have the Industrial and Commercial Bank of China, for which at the beginning of a sample, we cannot say that we have a lot of data. Okay? Each point being a fund, you see that at the beginning of a sample in the 2010, etc., there are not that many investors buying that stock. So if that is the case, we are going to have a lot of, these averages are going to be very spiky, and this is what you can see there. And as we move along, and as there are more investors holding that stock, which is after 2018, you start to see more funds, and in particular, you start to see some index funds. And this is the time where China started to be incorporated in indices, right, in MSCI index and stuff like that. Then you see that the volatility of the average looks a little bit lower. It looks a little bit more like the Apple stock towards the end of the sample. And indeed, if we look at the fit here for the Industrial and Commercial Bank of China stock, at the beginning of the sample, so the stock price is in red, we have our blue demand, recomposed demand component. It doesn't work very well, right? You see that we are not fitting. But you see that at the end of the sample, we are fitting again quite well. So that means somehow that when we get, in that particular case, when we get a few more funds investing, we get a better chance at fitting the data. And this is a general statement, but there are lots of, it's not. There are lots of exceptions. If I look here and I put on the vertical axis the average funds, number of funds holding the ISINs per month, So if you go up, you have more funds holding the ISIN. And on the horizontal axis, we have 1 minus the share explained by the total common equity component in absolute value. So if you're at 0, you are explaining everything. Okay, so you're good. 0 is good. You see that the more funds, the closer to 0 you are on average. But there are some exceptions. And you can be at 0, so very close to explaining a lot of what is going on with few funds. Okay, this can happen. But if you have very few funds, you also have the cases where you don't explain much of a variation, like the Chinese stock. So that's true for the number of funds holdings. And if I do the same graph for medium coverage of the ISIN, we have a bit of a similar picture here, which is, again, the higher the coverage, the more likely you are to be able to explain, to reconstruct this market clearing condition with more precision. OK, so now I've done that for 20,000 stocks plus. So the temptation is great now to aggregate and to look at the aggregate stock markets, right? So I can do that. I can aggregate my stocks by currency country, and I take a look at what's going on at the aggregate level. So this is what I'm doing next. And here I'm showing you how much, again, in a variance-covariance sense, but this time at the aggregate level, I can explain of a variation of all my stock markets on average. And here the answer is 96%. So that's pretty good. You see, these are all described by their currencies here. So I can take the Thai baht, the Thai stock market at the very right, or I can take the Swiss franc, or I can take the Korean won, etc. For all these guys, I get a pretty good fit. You note that the Chinese stock market in the left is the worst. Right? That's definitely, and quite significantly. And I think we kind of understand why. So what does it look like? Well, here the stock market, the aggregate stock markets in US dollar, in pound, the euro stock markets, the Japanese yen stock market, the Swiss franc, the Australian dollar. And you see you have actually 2 lines on this graph. But you kind of really see only one, because you have the actual stock market variation and the reconstructed one, and they kind of track each other quite well. And this is true, by the way, for emerging market as well. So at the aggregate, we kind of do quite well here in reconstructing. So this might be one of the only case in economics, I don't know, I mean, maybe not, where we start from a completely granular market clearing condition that we actually reproduce in the data, and we aggregate it up to the market level, and we kind of do fit pretty well. So think about it. If you were trying to do that with iPhones, right? So you would need data. You would need the supply of an iPhone of a certain type, and you would need data for everybody buying an iPhone in the world. You would aggregate that up and reconstruct it, okay? And then you would aggregate up at the goods market level, or maybe at the high-tech goods level, whatever you want. This would be the equivalent of what we are doing now, okay? And I think it would be very, very hard to do. Now, the equity market may be one of the only markets, international markets, in which we can actually do that, and it seems like the data has enough information to speak. It would be interesting to see if in the bonds market, we'll be able to do that, but I'm not super optimistic, because there are lots of different types of bonds, different issuance of bonds, and they kind of, expire after a while, etc. And there are all types of investors which might be very, very, very different with very, very different things, and I'm not sure it would average out in a nice way in the way it works for equity market. So as a thought experiment, I'm not sure we can actually do that for any other market in economics, but happy to be wrong on that. Now we also do everything at a quarterly frequency, and as I said, we check that there's nothing mechanical in this. Okay, so now let's interpret a little bit what we find because of this of this good reconstruction of market clearings, we can say a few things. And I'm going to insist on two facts. First one is that the properties of the co-movements of the subcomponents of demands with the price are very different at the micro level and at the macro level. It's going to be one thing. And the second thing is that my exchange rates there, they play an equilibrating role, which is an important one. And they have interesting things to say about safe haven currencies, non-safe haven currencies. And furthermore, because they are everywhere in my system, I can also recover them somehow, which will be the final thing I will do. Okay, so let's look at these properties of a decomposition. Now, at the micro level, so at the stock level, but by country. So each of these bars represents the micro level variance-covariance decomposition, but by country currency. Okay, so if we look at this diagram, what is striking is that the red, which is the weight changes, explain a lot in a statistical sense the price change, okay, for the stocks. That's a positive correlation. So essentially, you have a positive co-movement between change in weights and price. But we see a few other things here. We also see that we have a positive co-movement with the net returns of funds investing in stocks and the price. So if I have a US investor whose funds is mostly in the US investing in Colombia, I will have mostly the US return affecting the change in price in Colombia. That would be this type of co-movements here. I have the flows, which are the final investors, and they're always positive and significant, though you can see they are not super large here. The residual is plotted, so you see the residual there, and it's heterogeneous across the country. But maybe one of the most interesting observations is the blue stuff, the exchange rate. And you see that the exchange rate is negative. So what does it mean? Negative here means the currency is appreciating. So you can see that for most countries, and that's going to be very true, particularly for emerging markets, which are on the right, the Colombian peso, that's the Korean won, the ruble, the Czech, etc., Turkish lira. You see that a price increase goes together with an appreciation of a currency. It co-moves positively. But there's a few countries for which it's not the case. You see the blue line is positive, and it's significant, even though it might be small, but it's significant. There's the US dollar, there's the Japanese yen, and there's the Swiss franc. Then there's maybe some countries pegging to the dollar. Okay, but these are the important ones. And in particular, the US dollar and the Japanese yen always come out very strongly here. So that means in these countries, the price of stocks and the exchange rate co-move in a way that means that when the price goes up, the exchange rate depreciates. It's the opposite. These are the safe haven countries. Okay? So I will say a bit more about that, but this is an interesting difference to note. Now again, nothing mechanical. We show here, we have many decomposition, but index funds versus active funds. And we show the active funds essentially explain most of the variation. The index funds, they kind of amplify things. They always go in the same direction. And their relative importance depend on the country. All right. Now, I can do the same variance decomposition. I have done it already, but I'm showing you the results here at the macro level. And at the macroeconomic level, what is really interesting is that things changed in terms of what explains most of the variation in price. So here we go. We still have that the change in weights, the red line, explains quite a good chunk of a variation of the change in price. Okay, so you can see still large co-movements of change in weights with the price. If you buy a stock, the price tends to go up. This is still very true, in particular for all emerging markets, Brazil, Hungary, Colombia, etc., the Thai baht, we all see this red line. But these red lines become really small now. They were very big everywhere before. I remind you, they were, okay, shouldn't have gone. They were very big everywhere, okay? Now, they are quite different here. And they are on the negative side for our usual suspect, the dollar, the yen, and the Swiss franc. That's the weight change, okay? The correlation between the weight change and the price growth rate. What becomes much more important is the net return component. So the kind of wealth effects, the return on assets of investors, become a much more important component to explain the change in price, especially for these guys for which the wage change has gone down, okay, in relative importance. And then we also have the flows, which you see a bit more here, that matter and that drive positively, that are positively co-moving with the price. And then we have the residual, which is smaller. Look at the exchange rate. We have the same pattern. For most countries, in particular emerging market, appreciation as the stock price goes up, but for the US, Japan, and Switzerland, as the price goes up, depreciation. Okay, so now that's really different. So what's happening? What's an interpretation of what is going on here? Well, I think what is happening is the following, and we kind of did a decomposition of this weight rebalancing. So we looked at these co-movements between change in weight and prices in detail by decomposing it into on elasticity, on equilibrium elasticity, and cross-equilibrium elasticity. What we mean by that, we take this, it's a scale covariance between the change in weight and the price, and the stock price, and we decompose it in how is the stock price and the co-movements between the stock price and the change in weight moving when it's the change in weight of the same stock price and the change in weight of that stock price compared to the change in weight with the change in price of a different stock in that country. Okay, so that's on versus cross. And when we look at that, we find, again, this very striking pattern, which is that for all the emerging markets, well, first for everybody, the on elasticity is always positive. So price goes up, the stock goes up, when the weight change moves positively with that price. But the cross elasticities are very different. You see that for the emerging markets on the right, these cross elasticity are very strikingly positive, okay? While for the US, for Switzerland, and for Japan, they are negative. What is this? Well, so this has to do with the size of the currency market and the behavior of investors. What it means is that when an investor invests in Brazil, essentially that investor goes in and out of Brazil. He buys several stocks in the Brazilian stock market when things are more or less good, and he gets out of the Brazilian stock market when things are bad. So he goes in and out of Brazil. If he goes in and out of Brazil, he might go in and out of Turkey, etc. Out of Brazil into Turkey, out of Brazil into Colombia, okay? While in the US stock market, this is not what is happening. That investor rebalances within US dollar stocks. Sell one US dollar stock, buy another one. That's why the cross elasticities are negative in the US. And this is the case within these very special currency boundaries, which are the US dollar, the Japanese yen, and the Swiss franc. So there is rebalancing within these currency boundaries, while there is rebalancing across the currency boundaries for emerging markets. And that explains these differences in co-movements, and that explains the difference between the micro evidence and the macro evidence. That means the size of the market and somehow the specialness of the dollar, the yen, and the Swiss franc matter for these for these co-movements, quite a bit. Something we usually don't have very easily in any of our models. So I think from that, and because I have not made any assumption, essentially on any behavioral assumption, we can draw some implications for the way we should be thinking about asset pricing. I've just used market clearing condition and linearization. And what we see here is that, first of all, there's huge heterogeneity in weight changes. This was the upper graph with all my dots. But this heterogeneity, interestingly, largely cancels out, okay, in the aggregate. And still, this average has most of the information we need, okay, for our decomposition. So should we think about moderately heterogeneous beliefs or heterogeneous assets embeddings of investors? But then some of them do cancel out, so it would be interesting to know a little bit better what that means, right? And which ones cancel out in the aggregate. There is a crucial difference in terms of co-movements between exchange rate and stock market equilibrium for safe haven currencies versus the other currencies. Okay? So the other currencies, essentially, if you buy more Brazilian stocks, there are two ways you equilibrate the market. The price of a Brazilian stock goes up, and the Brazilian real appreciates. That's the way the market clears. That's not the same for the dollar, for the yen, and for the Swiss franc. That has implication, this cross-elasticities for this within currency border rebalancing for the role of wealth within this border. So there are more amplification, more wealth effects in the US, in big currency areas, in the US or the yen than in small markets. So again, we should think about financial multipliers, these wealth effects, etc. Now, the data is also consistent. I insist on consistent because I'm not testing anything with the fact that US investors are purchasing more foreign assets when their wealth increase. So more risk-taking, more foreign investment when their wealth increase. And this comes together with the depreciation of the dollar, which is consistent with a bunch of empirical facts that we have about the global financial cycle and in international finance in general. Of course, if we were to test more precisely, elasticities of demand, then we need to put more structure, and we can nest that within that setup, obviously, because it's just market clearing condition. Now, how about the exchange rate? Right? So the exchange rate, this variable that clears goods markets, service markets, bonds market, everything. Well, here it does clear the market too. So I have them. So why don't I invert the system and extract them? Okay, so this is what I do next. I'm going to be able to use my matrix of market clearing conditions with 33 stock markets and construct every bilateral exchange rate and invert that matrix. And I will get an expression for the exchange rate as a function of something like net equity demand, okay? Which is what I'm going to do. So this is what it looks like when I stack all my market clearing condition, and I have all my bilateral exchange rate here between the pound sterling and a certain currency Z, and all my bilateral exchange rate, the last one is the euro against the currency Z, and I can express it neglecting the change in supply term and neglecting the idiosyncratic term. I can express it as net equity demand. So this term that I have, a delta MCGBP, this is the change in the market capitalization of a UK stock market. Okay, so this is the supply side. This is the value of the change in the value of the UK stock market, minus the change in demand for the UK stock market coming from all the region of sales in the world investing in the UK stock market. Okay, and that demand coming from the region of sale is expressed in the region of sales currency. So that's a kind of net equity demand for currency here, this term, delta MC minus delta D. And I have the same thing for the currency Z. So everything can be very neatly expressed like that. neatly expressed. It's a huge matrix, right? So it's not so easily to construct it. So we started to construct this term, focusing only on a subset of the currencies, which seems to be enough to explain quite a lot of the bilateral exchange rate variation. So here we focus on the dollar, the euro, and the pound as the net currency supply, these terms. And this is enough, it seems, to explain the variation in most of the bilateral exchange rates. You see that we do very well for almost all the currencies. We're not doing so well for the Norwegian krona for some reason, the Turkish lira and the Indian rupee, but and maybe the Thai baht. But other than that, we're explaining quite a bit of a variation. So what does it look like? Well, again, I can extract a composition of the demand for euros based on these international equity markets from my equation. And this would be the red line. And I compare it to the realized exchange rate changes, which is the blue line. And as you can see, even with these three currencies, it's pretty good. And same thing for the sterling. So again, we have something which is able to reconstruct some equilibrium market clearing conditions for currencies based purely on equity markets data with a very limited amount of coverage. It's not only for the specific currencies, it works for it also works for the emerging markets, and it works for exchange rate vis-à-vis the dollar, but actually it also works for the exchange rate vis-à-vis the euro base. You can construct any exchange rate with this technique, and you get essentially the variation. Okay? So I think I'm pretty much out of time, so I just want to conclude by saying this is a very, very simple-minded paper. It just uses market clearing condition and just a linearization. But I guess the very big surprise for us is that with very, very limited amount of information, we are able to reconstruct pretty much this market clearing condition from the bottom up. It might be the only case in economics where we do observe market clearing in action. And this is maybe even more remarkable given the fact that it's a very, very international market with all these exchange rates kind of in this matrix. And I think from this simple exercise, in which any asset pricing theory can be nested, I think we learned quite a bit about co-movements of exchange rate and equity prices, also about rebalancing behavior of investors. And that from what I see and the implications that I think I've tried to show you between micro and macro, the wealth effects, etc., I don't think we have many actually asset pricing theories or model, general equilibrium model, that are able to reconcile this type of finding, let alone the fact that we still have to have our head around the fact that if the exchange rate fits so nicely in this international equity market, so how do we think about international bonds market in which exchange rate have been studied tremendously, actually with a lot of puzzles hanging around, the FAMA puzzle. We have the problems with interest rate parities, etc., and yet people have been very much associating exchange rate and bond markets. I think that may not be the right place to look. So our elephants have been doing a pretty good job. I think clearly this cries for more theory. So I'm looking at this paper as really much more a beginning than an end. I hope you will agree with me. Thanks a lot. And
All right, so now we have time for questions. If you have a question, raise your hand.
Thank you. So firstly, thanks for the presentation. And I would have a question to the exchange rate component. Like for me, it's like related with global risk aversion. And there's a paper by Cormoon and De Leo. They basically show that the decline in global risk aversion is depending on the net foreign asset position of the economy creating like an increase or like appreciation or depreciation. So is this also like related with your results or the importance of this net foreign asset position?
Yeah, so you're thinking about more, putting more structure in how we can think about these co-movements between exchange rate and wealth, or exchange rate and restaking and equity prices. So I think that's exactly the right way to go. I think we need models when we think about portfolio rebalancing. So the degree of restaking is influenced by wealth, or who has the wealth. So we might have a lot of, heterogeneity of investors with different degrees of restaking. And I think these results are consistent with the fact that we have a lot of pools of assets, a lot of wealth is in the US, right? And so when there is good news for the US, and this is consistent with a lot of, of papers which have been written on global cycles, etc., you see a lot of things happening. So you see more inflows in emerging markets, more inflows around the world. So there's an increased restaking by US investors in the sense that they go in foreign countries. And this increase in restaking comes with an outflow, essentially. So here we would see it with a depreciation of the dollar. So I think that explains part of these co-movements. And this is particularly strong for assets with large pools of wealth. So that's typically the US dollar. I think that's why you see this disproportionate effect on US news in asset markets around the world, and also why you see with co-movements between dollar and international capital flows. I think this is very consistent with this type of things. Now there's also the opposite thing, which is the safe haven properties of the US dollar in bad times. So in bad times, when every stock market goes down, essentially, there's a repatriation of liquidity towards US assets, and so that creates also this co-movement conditioning on bad times. So I think there's this type of models that are not necessarily consistent with a lot of the existing theories of asset pricings, are consistent with this type of co-movements.
Thanks.
Very interesting paper. I know you insisted a lot that this is covariance rather than causality, but I'm still interested in how, if you can say something on the relative magnitude of the causality relationship. So is it more that in appreciating currency pushes the stock market up, or that the increasing stock market has a push on the exchange rate market for smaller countries?
Well, this is also a question I'm very interested in, but unfortunately here I really cannot say anything about that because I don't have identification. And the only thing I have is really the old, in a way, portfolio balance effect that is embedded in the market clearing condition, which is that, somehow we have an increase in demand for a certain asset, let's say a Turkish stock. There are two ways the Turkish stock market is going to clear: by increasing the price of the Turkish stock market and by appreciating the Turkish lira. So conditioning on a demand shock, you have two ways of clearing the market. Now, we also know that the demand on the demand side depends on, the price, and we have momentum people out there and things like that. So causality goes definitely both ways. And until we have a more structured model with instruments, essentially, or we're able to do some identification here, I won't be able to assign this type of things. But I already find it quite interesting that the market clearing mechanism, via the exchange rate or via the price, is very heterogeneous across countries.
This is all quite amazing. But what do we know about the other animals? Is it by coincidence that we just pick up the right kind of dynamics by looking at this Morningstar sample? we would expect, I mean, I guess to some extent, intuitively, index funds are, as you also showed, are not that important as active funds. Now, one could have a theory of saying active funds are driving everything and all the rest is noise around it, and then maybe this representativeness assumption is in fact sort of okay. But I mean, what do we know about whether this assumption could make sense?
Yeah, I think this is the question that keeps me, no, it doesn't keep me awake, but I was really, to be perfectly frank, I was really surprised because I thought, investors are heterogeneous. So it would be very strange that for some reason the Morningstar data with this low coverage is representative enough to get a good fit. And it seems it does. So, and it seems that indeed, when we do this decomposition between people who are actually trading the stock and people who are holding in a passive way the stock, it's the marginal guys, so the people who are trading the stock, the change in weights of these guys, who are driving, well, I'm not saying driving, who are in a statistical sense driving this covariance. And the fact that the other guys who are purely passive are just amplifying. I mean, this is understandable in the sense that you are holding the thing, the other guys are driving maybe up the price, so this is kind of showing up in your weights as well. But you are not, an actor in that. But why is it that this sample of Morningstar mutual funds, active guys, is actually enough information to explain in a statistical sense the price? I don't have a good explanation for that. We haven't talked to the Morningstar people. Maybe we should, or maybe it is the case. And I mean, that's a hypothesis to be investigated. But a lot of these investors, in Morningstar or not, are using the same type of software models of factor investing in some ways or the other, and effectively what we are picking up is something like that, fundamentally. But then we also had, remember all this heterogeneity of the points that I showed you for the Apple stock, but that's true for other stocks. So it seems that maybe there is an average which is priced of some kind of factor investing, which is common to all people. And then there are all these, I don't know if we call them heterogeneous beliefs or now assets embeddings, right, that vary a lot across investors, but a lot of that stuff cancels out. So what does cancel out and what doesn't cancel out is a very interesting question. We have to zoom in on that and understand better what is happening. At this stage, I really don't know. And indeed, I'm interested in all these other types, possibly of animals, but that do behave like elephants or follow elephants.
We have time for one last question.
Hello, thanks a lot. Did you explore also whether there are changes in the decompositions over time? Like, did you split the sample? Did you explore this? If, for example, portfolio weights became less important, or because you showed us the overall decomposition, right? Could you do that, or like before the euro crisis, after, or before Brexit, after Brexit? I don't know.
So we can do some cuts. So there we will have to, to be careful to differentiate between what might be due to true kind of changes of movements and what is made due to better, fit of the data. So I show you, for example, in the case of China, if I do something at the beginning of a Chinese sample, it's going to be super noisy, right? So it's going to be biased all over the place. Towards the end, it gets better. So for different countries, it's not as stark as for China, but we are going to have issues a little bit of that type. But we can definitely, explore that some more. It's a big good thing to do.
So let's give a big round of applause to Professor Rey.
Thank you.
And enjoy the rest of the conference.
Okay, so sorry, before everybody goes away. So we are all here very, very happy to be together, Econometric Society and the European Economic Association. Next year, as you know, it is not a joint congress, because the Econometric Society is the World Congress, which will be in Korea. And the European Economic Association will be after the Econometric Society. But so this is just to to invite to invite all our friends here when they come back from Seoul to drop by in Bordeaux, where the European Economic Association Congress will be. And so I hope we will all be able to drink to economics together.
Really great talk. Congratulations.
Thank you.
The way you interpret your paper, or can you interpret your paper